All right. We're now recording. So good morning, everyone. It's so good to have you here. This is the 21st Paparelli Zoom chat for entrepreneurs. Thanks for coming. Kathy and I, as you know, I've taken a couple weeks off, and last week, Kathy and I were on a motorcycle adventure where we went from the middle of Colorado from some ranch there and went over the Continental Divide and through Utah and uh, through Utah, then Nevada, and then we ended up just north of Los Angeles. So it was a 1,550-mile ride. Most of it beautiful, some of it a little hair-raising, but we got through it. It was a great adventure. So it's good to be back. So let's get started. I've been an angel investor for the last 27 years. I was inspired to become an angel investor by Sig Mosley, who invested in a company that I was running at the time. And Sig was actually leading an organization then called Imlay Investments. He was probably the most active angel that we've ever had in the Atlanta area. And Sig and I, as I got into angel investing, I realized pretty quickly that Sig and I had two very different models. Sig would invest in high growth companies. He was on the hunt for these unicorns. And so he was always expecting that there would be venture capitalists or institutional money that would follow him in. So his investments always required multiple rounds. Whereas my companies, my companies were really, I was looking for companies that were going to get to cash flow positive sooner rather than later, yet maintain a modicum of growth, and so that they would continue to increase in value. So my companies may require another angel round, maybe two, okay, to get to that profitability level. So we had these two different models. And this difference in these models was a basis for very different term sheets. My goal was to own, his goal, I should say, was to own a small percentage of a very large company, which he did in a $1 billion opportunity, which was his greatest return ever, which everything else paled in comparison from that particular thing. My goal was to own a larger percentage of a smaller and profitable company. But there's a problem that arises from this. What happens when the entrepreneur I invested in decides he wants to go really big, like Sig Mosley big? That's when the problem showed up. And I would say, like, it happened to me a few times, you know, I was thinking, wait a minute, we didn't agree to this. You know, I don't want institutional investors in my deal. But my partner, the entrepreneur, does want the big money. All of a sudden, me and the entrepreneur, we're not on the same page anymore. Our goals for the company have changed. We think startups and entrepreneurs are really all about technology, the success, and the money. But first and foremost, it's really about relationships, the people, their motivations, their aspirations, and their resources. And that's what we're going to be talking about today. Our topic is, have you outgrown your investors? This is the Paparelli Zoom chat for entrepreneurs. We're all about entrepreneurs, helping entrepreneurs. Being an entrepreneur and leader these days is, or any days, is a pretty lonely job. You know, so please use this forum to learn and share with your peers. We are a community of entrepreneurs. Together, I believe, we are stronger. Please put this Zoom chat on your calendar as a recurring event. The link will always be zoom.paparelli.com. That's zoom.paparelli.com. You put that link in there. You can click it any time to see what's coming up. And if you click it when it's active, we'll be here for you. You'll never miss one in the future. I appreciate you being such loyal fans here. I'm investigating moving also. I wanted to tell you, I'm investigating now moving from this gallery meeting to a seminar format. We got Zoom bombed pretty heavily last time. This means that the only people that you're going to see is me, my guest, and my co-host. You'll have an enhanced Q&A function, but the biggest impact is we'll lose some of that early first 15 minutes sort of networking time that we have. But the real benefit again is that for the call is no Zoom bombing, but on the other side, the benefit for you is you don't have to get dressed for this call. But send me your thoughts on this. I'd like to get feedback from you. I'm pretty sensitive to that first 15 minutes. There's also a resource tab on the paparelli.com, includes information you found valuable as a CEO to share with your fellow CEOs. If you mention some resource on this call, please send it to me. The house rules are listed in the chat. Use the chat to ask questions. Greg Hinthorn today is monitoring the chat for us. He'll jump in from time to time with your questions during my interview if it's appropriate to the conversation at the time. If not, you can ask your questions later after the call as my guest, Jason Moore, has agreed to stay an extra 15 minutes from 8:45 to, from 9:45 to 10 o'clock, and we'll get through all the questions then. The entrepreneur's thought of the day from the Bible with regarding to this topic is from Genesis 13:8-9. So Abraham said to Lot, "Let's not have any quarreling between you and me, or between your herders and mine, for we are close relatives. Is not the whole land before you? Let's part company. If you go to the left, I'll go to the right. If you go to the right, I'll go to the left." And the application here is pretty obvious. As opportunities present themselves, partner goals may change and be in conflict. This is a pretty high quality problem, but a problem nonetheless, and it needs resolution. So today, to help us with that resolution on how he did it, is my guest is Jason Moore. I was introduced to Jason by Benj Miller, hopefully who's on this call, a friend and EOS entrepreneur system consultant. Ben is also an entrepreneur, having started several companies, and he continues to do that. He and Jason have a lot in common. Ben thought Jason could share some of his valuable experience with you, his fellow entrepreneurs. Please call me with your friends that you think have an experience that would be beneficial to our audience. When speaking with Jason, I realized he recently completed a transaction with Fulcrum Equity Partners here in town. The round was led by Philip Lewis, their newest partner and a good friend to our Atlanta technology community. I know a lot of you know him. Fulcrum led his first institutional round, and they're very excited, as you heard from Frank a little earlier, about this new investment in Jason's company called Stratasan. Jason agreed to tell us a story. I know you're going to find it interesting, but more importantly, helpful as you wrestle with your next growth step and potentially seek further investment from new investors. So I'm excited also that Jason is a UGA grad. This provides a bit of balance against all you Georgia Tech guys that are on this call. So Jason, welcome. Please unmute yourself if you would.
Go Dogs.
Oh, go Dogs. All right. Kick it off right, Jason. Go right for the throw. Yeah. So Jason, you know, I was noticing on your profile on LinkedIn is that you're a graduate from UGA, but your degree was in philosophy. And we have a lot of people that are entrepreneurs and think that, oh yeah, you got to go to Georgia Tech and get some sort of an engineering degree to get into this whole entrepreneur thing in technology, but you don't have that. You have a philosophy degree. So how did you navigate to become really a tech entrepreneur?
So after I left, it's interesting on my background. Philosophy, I think, actually helps me every day in the sense that I have to bring in a lot of inputs and kind of distill down some information. It probably wasn't as helpful in the beginning, not knowing, like the deeper connectives or the deeper metrics of business itself. But I had two partners in my first company that we started in Atlanta. We started working on it in 2000 and launched it in 2001. So we had that company for about 10 years. I had moved to Nashville for personal reasons in 2004, but kept going back and forth between Nashville and Atlanta to continue that. So really the way I started was getting with two friends from college. We were kicking around ideas to start a company. We landed on one, and so we just kind of did it. Back then, mentor groups and entrepreneur centers were much less to be found than they are today. So
Yeah.
we started in my friend's basement, and we kind of went from there.
Where did the entrepreneur, but where did you get this whole idea of being an entrepreneur even, from a philosophy major? I mean, you don't have that business background when you came out of school, right? So it's not like, oh yeah, you need to do this thing.
Yeah, I mean, I would say that I landed on philosophy not necessarily as my first choice. It was a way to get out of college.
It's an awful lot of reading and writing if you're doing philosophy.
Yeah, and I don't mind that. And so as a young child, I grew up in rural Kentucky,
Okay.
and so not a lot of exposure to what like a company like Stratasan or companies, investable companies are.
Mm-hmm.
I think a big business that I was maybe exposed to that somebody actually had ownership of would be a 5 or 6 person CPA firm or something to that effect. Like that would be a big company to me as a younger person. But I always, my parents will say, I always said that I wanted to own my own business. And I think though, to my definition of that at that time was, probably like a lawn care company or something to that effect.
Yeah.
I mean, because once again, the scope was fairly minimal. I didn't understand that you could actually go start a scaling.
It's interesting that you say that, so that you're talking about probably when you were in like junior high or high school,
Mm-hmm.
that you had this sort of view. And I find that, having been serving entrepreneurs and working with entrepreneurs all my life, really, is I find that that's the case, is that people often, in fact, in almost all cases, come to the conclusion that they need to be in there. They have this vision that sort of, I think God gives them, that says they're going to be in their own business. They don't even know what a business is at the time, but they know that they need to do their own thing, if you will, not doing someone else's thing,
I was probably 13 or so when I stumbled across this candy wholesale company in this alley in a little town, and I saw that they sold these boxes of blow pops for like $6 and for 100. And so I got my mom to give me the money to buy 3 boxes. And I literally went to school and started selling them for $0.25 a piece. In high school, I think it was my sophomore year, I basically would carry around my books because I had my backpack full of blow pops that I would be selling. And I got called to the principal's office. He said I had to stop. And the second time, when I didn't stop, the second time he said, "Okay, Jason, I have to tell you, I know you're not doing anything wrong, but contraband is contraband. So if you keep doing this, it's going to be treated like you're selling drugs. So you really need to stop doing this." So I had to stop my first business. It was going to be an
enterprise. There you go. So you almost got expelled for selling blow pops.
That's correct. That's correct. And nobody at the time wanted grape. So if you bought 4 for $1, you get a free grape blow pop.
Well, man, if you would have started with books, you could have been Amazon.
That's right.
Blow pops just weren't the thing.
That's right.
So how did you go from this? How did you go from them blow pops and this business that you started in Atlanta, which kind of helped build your network, I would think? Like you said, you went to Nashville. How did tell us a little bit about the founding of Stratasan, a little bit of the history there? I know that's a new name from what it was. So go ahead, give us a little bit.
So as I mentioned, my partners were still in Atlanta. I moved to Nashville for personal reasons in 2004. But I stayed with a company called Big Web Apps. It's now Sherpa Desk. And until early 2011, I started working on Stratasan in 2010, and worked it out with my partners for the company to buy me out when I was exiting. And really, my networking in Nashville started in 2008. I really was basically in my basement for 4 years, basement or Atlanta, going back and forth. I knew no one.
Wow.
That's
a long time.
Yeah, it was. It really was.
I bet it was, yeah.
When we had our second child, we have 5 children now, but when we had our second child, that was when I really needed to get out of the house more. But Nashville really didn't have an entrepreneurial community at that time. It was a very entrepreneurial city, but there was really no groundswell of new or young entrepreneurs.
And that's like 2008?
This was in 2008, yeah. And
okay.
and the first Nashville bar camp happened, and I happened across this YouTube video, and I was really wanting to get to meet people in Nashville. I just didn't know where to do it. And I saw this video, and anyway, there were two guys on the video, Dave Delaney and Marcus Whitney. And I watched this video of bar camp closing. I said, you know, if I could meet one of those two guys, that would probably set me off.
What's bar camp, by the way? I didn't know what that is.
Bar camp, they were popular for a while. They basically a gathering all day. Originally, it would be, you would come in, fill out a Post-it note, put it up on a board that you would want to speak on, a topic that you would want to speak on for 20 to 30 minutes. And people would basically kind of vote on what they wanted to listen to. And the people that got the most votes got the bigger stage. And the people
love
that
it.
didn't get any votes didn't speak. And it was very, I think, yeah, Nashville had some. And then basically from that, I saw, you know, there's two guys, Marcus Whitney was one of them, ended up meeting him. He's a great entrepreneur in Nashville here. I ended up being the best man in his wedding, strangely enough, from this YouTube video that I saw in 08. But the way I really wanted to meet people, or I thought, I'd heard about an event in Atlanta called Startup Weekend. And I said, what better way to meet people than to attempt to throw this event? So I literally knew no one in town. But we were able to pull it off, and some of my best friends in Nashville now, you know, came from.
So where did the idea of Stratasan come from?
The idea from Stratasan, so basically so that's 08, move into kind of 09, 10, I started realizing that it was probably time to start something new in Nashville. The company that I was a part of was growing, you know, not so good. And it was at a point where it was probably getting further and further behind the curve. So I started looking around Nashville, and basically you have music. I can't sing or play any instruments very well. Publishing, like book publishing, that wasn't interesting. And then you have healthcare. So if you're networking in Nashville, you're talking to healthcare entrepreneurs, basically, healthcare executives. And so I started noodling, you know, around and trying to figure out, you know, something that there may be a gap involved. Interestingly enough, when I started Stratasan, you know, Stratasan is a healthcare data analytics software company.
Okay.
I had 0 days of healthcare experience. I'm not a data scientist or a data analyst, and I've never written a line of code. But what I did have that I felt like I could bring to the table was running a SaaS company, you know, from the company in Atlanta.
So did the idea actually come from your co-founders as opposed to from you?
Yes, advisors, really, kind of people that I were, you know, meeting and trying to discover, like, what is a pain point that you have. So I was compiling a list of things that we could potentially do.
So you chose healthcare as the vertical that you were going to go after in Nashville, and then you started doing sort of customer discovery type work. That's what it sounds like.
Mm-hmm.
And from there, that's when you start networking meaningfully, right? Meaning that you find other technology guys that are in healthcare, and that's how it kind of all came together.
Yeah. I actually didn't like the idea of Stratasan at first. And mainly because I felt like the gap that was being explained to me was probably not as big as they thought it was. I felt like people were actually doing it better than they were. And really, once I started, but one of my advisors really kind of pressed me, is like, you really do need to consider this and research it. And if it doesn't work out, fine, but research it. And the research kind of showed it was kind of the classic innovator's dilemma, where you have the big behemoths. At the time, it was Thomson Reuters Health, which became Truven, which is now IBM Health Watson, advisory board, which is now part of.
So then, help me with this. How did you? So here you are again, a non-technology guy, if you will, right? But you want to operate a company. How do you find your partners to pull this thing off? Because that's a big problem that other entrepreneurs have that are non-tech entrepreneurs. They're like, I can't write a line of code. I need somebody who can kind of work with me on that.
Yep. So I talk a lot about lucky bounces, and one of the guys, harkening back to Startup Weekend, one of the guys that helped start that event had hit me up. He knew I was wanting to get out of my basement. And he said, I've got this room in my office that, you know, they had a house for their office, and one of the rooms wasn't used at all. Okay. And we didn't have co-working space in Nashville at all at the time. maybe some Regents or something, but nothing innovative. And he was like, would you want to rent a desk in that room? And so we agreed upon $100. And once I got there, he was like, you think other people would want to do that? Because there were 2 other desks. He tweeted about it. And lo and behold, the guy that showed up in shorts and t-shirt that had just moved to Nashville from New York, 2 days later is now my co-founder and CTO. So
Wow.
he was, yeah, I mean.
So how did you guys go about, how did you go about getting the company? So your only overhead right now is you're not getting paid, he's not getting paid, and you're paying $100 a month in rent. Eventually your expenses start going up because you got to live, you got kids, right? So how'd you go about funding the company initially?
So he was still doing contract work as a freelance developer, and he was still getting New York rates. So he was just fine. He had no intention of co-founding the company with. And then I was still running with my partners. I was still running the company in Atlanta. So so we were noodling on the idea at this point. This was late 2009, early 2010. We didn't really found the company until late 2010, and we don't really we count the anniversary as May 2011. Just that's when we secured our first round of funding.
And how'd you get that first round?
So I heard about this new initiative. It was a public-private partnership in Nashville called the Nashville Entrepreneur Center. Michael Bertram was running it. I had heard that I'd been invited to this event. I knew I didn't qualify for it, so I said no. But then I heard Michael Bertram was going to be there, so I called them back and said, "Can I still come?" They said yes. So I literally went there only to introduce myself to Michael Bertram to see if I could get into the Entrepreneur Center. Which this was a Wednesday night event, 10 or 11 o'clock at night. I go up to Michael and introduce myself, tell him what I'm kind of working on. He said, that sounds great. Do you want to come pitch? I said, absolutely. He invited me to pitch the very next morning at 8 a.m. I didn't have a deck at all. I was still, we were still very, very infancy stage. So I stayed up all night, put together this deck, showed up at the Entrepreneur Center about 7:45. I give this pitch. That was the very first day that the Nashville Entrepreneur Center, they weren't even open yet. That was the first day they were assuming the space. So there was no furniture. There was one table, that pop-up table that we sat around. I gave the pitch. Michael said, I think you're onto something. He's got a health care background in data, so he kind of understood the problem. He said, I like you. He said, I have to say, Jason, that's the worst pitch I've ever heard.
There you go.
Yeah. And
not a lucky bounce there, right?
But he followed that with, if we're going to be good at what we have been saying we're going to be good at, then we should be able to help you, formulate an investable story for this company. So I literally moved in about 2 hours later and popped up my own table, started borrowing internet from the Hard Rock Cafe across the street, and got to work on building an investable story.
So
this was
September. Who was that first? Who was the investor who jumped in on this thing? Did you put a term sheet together and a bunch of angels came around it, or did some angel come in and give you a term sheet and say, this is how we're going to do the deal?
Our previous investors, we were more of a tweener state. They weren't really angels. There was an angel size round. I don't know if you all are aware of 10 Invesco, the state bond program to encourage entrepreneurship. It was one of the funds that got money from there. So it was technically institutional money, but it was more angel size.
Yeah.
So no, I did not put a term sheet together. They brought a term sheet to the table. This was in April of 2011. The terms weren't great, but we had $18,000 in non-recurring revenue
but there must have been, I think when you and I talked, that there was some lead investor on this whole deal that became sort of your financial partner, if you will.
Well, XMI High Growth Fund was that lead partner.
It was.
Now I did raise like a little friends and family $50,000 round, but that was really extremely early on. That was actually when I was moving into the entrepreneur.
How long did it take XMI to come into the deal?
So I started working at the Entrepreneur Center on the deal September 1st of 2010, and we signed the deal with XMI May 18th of 2011, and we probably started talking to XMI, I would say in mid-March of 2011. So probably 2 months after we really got focused on that. lucky
And
bounces.
that was real angel investing at that point, right?
You know, it's that tweener state, really. It was, they were institutional, you know, they weren't people, right? They were institutions. So XMI High Growth Fund was created to spur this. So it was really kind of in between angels and a Series A. It was more institutional seed capital, if you will. The total round was 2 tranches of just under, just south of 1.5 million.
Okay. What was the first round?
The first tranche was 750, and that was May of 2011. And then we took down the second tranche in October of 2012. So
what were those investors' expectations? Like what were they looking for you to accomplish?
so taking your intro, it was both, right? Like you know, Nashville investors typically are looking for profitable to soon to be profitable companies, right? But they also want to say that they're investing in high growth companies, which is very, you know, as you mentioned in your intro, that those can be very much in conflict.
Yeah.
And I would say that was their expectation. They wanted me to make money right out of the gates, but have 70% growth, you know, year over year. Like,
of course, that's what we all want, right?
That's right. That's right.
Yeah.
And you know, that's not a knock. It was just that there was, but it did, you know, it did cause a conflict of future thought. So, but really in the end, I didn't raise enough money to go lose a lot of money. And, you know, that 750 lasted from May of 2011 to October of 2012. We took down another 700,000.
Yeah, but do you think that a lot of that the money lasted so long is because the expectation was that you were going to move to profitability sooner rather than later?
Yeah, and that matched my
personality. You got to be tight with your
personality.
funds, right? I mean, if I say, "Hey, don't worry, man. You know, there's more money that's just going to keep coming," that would change the way that you think about how you're going to invest the money that you receive.
Mm-hmm. Well, and it matched my personality too. The company that I started in Atlanta, we bootstrapped that from the beginning. So
okay, good.
I'm kind of an operator at heart.
Basically.
I think, you know, there are a few fulcrum people on here. They've had to teach me how to spend money before we make money. It's kind of tough. Like I'm doing it now, but it was new to me. That was the first time, July of 2019, so that basically that round, 2 tranches, May of 2011 and October 2012, carried us through last year, July.
So then you came to a point that you said, okay, I don't think that we're going to have 70% growth and profitability here. And there was some thinking that you went through. Can you kind of take us through on what you raised money on, the expectations you set, and where you were headed, how it changed, if you will, and which changed your funding requirements? Tell us that story.
I think while we were staying right at that break even and slightly profitable because we didn't have money to lose, our attempted focus was building the foundation for scale. So there was always an intention of another round, right?
Okay.
There was always, and that was because once again, they weren't angels, they were institutions. So they had a timeline. They had, you know, they had expectations of return. Not just, you know, they had a certain expectation of returns because they had LPs and all that good stuff. And in late 2018, that's when it really hit me, which was, if we're going to do this, I think now is an opportune time. I think we have some tailwinds. We were getting to a point where about 30 people at the time. We were getting to a point where we were too big not to have the processes. I'm big enough to start building some of the processes, and really, I started looking at my financial partners at the time, which were very helpful. They got us from literally ground zero to 9 years later, and ready for this next round. But I started looking around the table, and there weren't operators around the table, and that was really what was. What were
you at on a annual recurring revenue? Where were you at in 18?
I think we ended 2018 with a 4.8 run rate.
Okay, great.
Then we were kind of moving towards, I think by the time we did the round, we were at like 5.5 So
Okay.
just north of 5.5.
See, but I could tell you as an angel investor, I'm looking at, you got 4.8, you got a business that's like break even to profitable. You know, it's not really needing any more money. If it did need some money, we can put that in too, you know, but there was this sort of there was this separation. Okay. One going left, one going right. What was that? Can you describe it?
Yeah, I would say it was looking around the table and not having operating partners.
That was it.
Uh,
These were just financial guys.
they were just financial. Yeah.
Okay.
And not being able to lean on them for those operational decisions that I was having to make. And even, you know,
Like what? Give me an example.
how to scale a sales team. I mean, that's probably
That was
the
a
number
good one.
Yeah, that's a good one. And
That's a good one.
and here's the thing. One of the things I learned post. So I have three investors now. Fulcrum led the deal. There's Blue Heron Capital out of Richmond, Virginia, and Frisk Cressy out of Nashville, Chicago. And it's been unbelievable. Like 16 months in, I guess, 15, 16, 17 months in, it's been an unbelievable partnership because what I wanted were operational partners that could help me answer the questions that I was asking. And I got that in spades. What I got in bonus was them asking me questions that I never considered. And like
Okay.
that was a big gap that I had previously.
But I'm still a little vague on when you kind of got to that point where you said, you know, I really have, you know, I understand the operator, that they're not operators, that the initial partners weren't operators, but there was also this piece that says, I really want to go big.
Mm-hmm.
Okay. There was more than just operators. Okay. Yeah, I can get advisors in that can help me along, but you wanted to do something that was big. When did you go to, this could really expand to something well beyond anything that we thought it would be to start with?
Yeah, I mean, I think we always had that as the intent. It was just, you know, I'm a realist, and it never was clear, like it was coming more and more in focus, right? So as we were cresting over 5 million in revenue, those are, you know, kind of key points. It's not 10, you know, where PE is going to be extremely excited or extremely open to. And you know what I started getting concerned with is if we stay right here, we're probably going to shrivel and die because because that gap between 5 and 10, you know, PE's not interested. There was
but
not.
you know, you were in it for long enough that, you know, one of the things that happens is you kind of get used to each other and you get used to the way you operate and you get used to the excuses on why didn't it grow faster, and you kind of just settle in. You did. I mean, you made a decision. I'm not going to settle in. Right? I mean, we do get used to each other. It all started working. I mean, it's like you've been together for, you said 11, right? So that's 7 years you were together. I mean, hey, we're all buddies here. We get together, we have the same board meeting, we ask the same questions, and we do the same things. And heck, we built a company that's 4.8 million. It's growing. What the hell?
Yeah, I guess that got less exciting, or actually got scary. I mean, it was the future that scared me, which was if we don't do something, we're going to shrivel up and die.
Okay.
I mean, that's
well, then what was the conversation with the current investors about sort of this next deal here?
The
institutional investor side.
The then current or the new current?
The then current.
Then current. Yeah.
I want you to talk about me first before you talk about Frank.
Yeah.
Philip, okay?
It was not a great, fun conversation the first time. You know, it was one of those, it's you, not me. And we need to move on. It wasn't technically that, but I mean, that's the message they heard. And it was at our January 2019.
We love you, but we're leaving. Is that what they heard?
Yeah.
Okay.
Yeah. I was like, I think it's time. And look, I think as a CEO, you have to know this is your call to make. It's your responsibility, right? The relationship with your investors is your responsibility, but it's also your responsibility to say, I think we need to make a change.
We get all that, and you did it.
Yeah.
Well, what's the interesting part is to say, so how did that conversation end?
Well, with us getting new investors and buying them out. But it started in January. It didn't end until end of February.
Getting new investors and then buying out the XMI, the initial investors.
Recap and growth round. That was one of my stipulations. It had to be a
That was your stipulation?
Yes.
You didn't want to bring the XMIs with you in this funding round.
No, I thought it would
Why
cause
not?
confusion and sharp elbows in a room.
Huh. Okay.
Yeah, it had, so I had 4 criteria if you want to hear those as to what I was stating. One was when I went to the website of the investors, the founder or partners had to be a string of operators, right? They had to make their money on this side of the table, not that one. They can be making a lot of money now on that side of the table, but I needed people that had experienced this seat. So that was number one. If you didn't pass that test, then that firm was cut. And I think this may be a big point. The second part of it's you, not me, and we're going to move on. The second part of my conversation with my previous investors was, and I don't want to use a banker. I want to run the process myself.
Okay.
That went over like a lead balloon as well. So it was like this double whammy of, disagreement. But I just said, look, I keep constant communication with you. You can jerk the leash anytime you want. Give me a shot at this. Nobody can sell this company like I can. I don't think a banker can come in. We don't look as pretty on a spreadsheet as they do. What's that?
Give me number 3.
Number 2 was they had to be willing to write a recap check, right? So vast majority of the money coming into our company is going out of the company because we're recapping out. So they had to illustrate that they do that. Third was also we needed growth capital, and I put together a story for that.
Okay.
And then fourth was the only optional one, which was I'd been at this game for 19 or so years. I have 5 kids. One of them was a sophomore in college at the time, which means I had 0 savings. I had 0 retirement. I had 0 college funds. So I wanted to take some money off the table just to secure a few things, pay off a home equity line of credit, and make sure.
So you wanted a payout too to kind of put you in a better position going forward.
Yeah, I still don't call it a payout. I call it a buffer.
So how did you find these people?
I dug up basically inbound emails that I had ignored for forever. I don't like raising capital. I'm an operator. I don't like to chase the money. I like to raise capital.
Anybody who likes raising capital, raise your hand. There ain't no hands going up.
Probably the wrong answer, or probably the wrong audience for that. I know those types of entrepreneurs that play that game. I don't know how to play that game well.
Yeah.
So I started digging up, and I spent a long weekend going through those 3 criteria, not necessarily taking money off the table, but does that team look like operators? Yes. Do they do recap?
Did you just do it on the web? Is that what you did?
Yep.
Okay.
And I came to 11. I came up with 11 names. I sent an email that gave them more information they probably would an intro email, typically get.
Oh, this is a cold email. This isn't something you didn't have warm introductions.
No, I mean, a lot of times I was replying to an old email that they had sent to me.
Because of course you've gotten hit up. You had 4+ million in recurring revenue. You had everybody talking to you. Yeah.
I think the oldest email that I responded to was 6 years old.
Okay. That
person wasn't still at that firm, but it did get forwarded to somebody that responded. But the email I sent gave them more information, kind of a teaser email with revenue and where we're at. I said, I need to make this efficient, yada, yada. But I did have a stipulation for a call, which was I want a partner on the call. I need this to be efficient.
Did you mention in the email that this was going to be a recap and payout?
Yep.
Oh, you did.
Not a payout to me, but a recap, yes.
Okay, but a payout to the current investors.
Correct.
You did. Okay, good.
Yep.
And so, how did you select Fulcrum? Tell me about Philip.
Yeah, I think he's on the call, by the way, or he was.
I hope he is. We're going to say something. Yeah, he is on the call. We're going to say something nice, Philip. Get ready.
So I have to say nice things about Philip today. No, Philip. The first time I actually met Tom Greer first. Okay. So strangely enough, Tom was in Nashville, I think, visiting another one of their portfolio companies, and he ended up coming by the office, and we chatted and had a great chat for longer than we had anticipated. The first time I met Philip was when I was coming down for partner, the bigger meeting. I was thinking there were going to be 3 or 4 people in the room. I don't know, Philip, felt like 20, 16, everybody came in, and which meant they were interested, right? That felt good, but I really wasn't mentally prepared for that.
Maybe it meant that no one wanted to make a decision and be responsible for it.
That's not for me. That I don't know that part of the story.
Okay.
But I had met Tom. I had met, I think, one other person over the phone. I think Philip had been on a call before, but never in person. But he was sitting just to like visually, he was sitting to Tom's right, which is directly across from me in this large table. And he's the guy that was just peppering me with hard but really good questions. And I had literally 3 answers to any question. It was basically I could answer it. I don't have that answer on me. But I'll follow up with you. And third, I was very transparent on we don't track anything like that. And that's part of why we need investment. We need better processes. We need better metrics. We need better scalability.
Good. And so,
can I add one thing?
As the deal was I'm sorry, go ahead.
Let me add one thing. There were two investors really still in the fold at this point: Fulcrum and Sarant Capital out of San Francisco. Both great firms. And Sarant was flying in on Tuesday, and then I was flying to Atlanta on Wednesday to meet with Fulcrum.
Yeah.
The previous Thursday, our largest and longest standing client had just been acquired by a PE firm, and we got line itemed off. So that was Thursday. Friday morning.
What was the annual revenue got line item off?
750.
So you're at 4.8. You're now at 4. Cool.
We were at this point, we were probably at 5, and we were back down to sub 4.
Okay.
And so Friday morning, right? So this is prior. I have 3 people taking red eyes to meet me from San Francisco, and then I thought 3 or 4 people in Atlanta waiting to meet with me. Come to find out, it was, I don't know, 15. But I email Tom and Philip, and then Kennedy from Sarant Friday morning, and say, hey, I need to talk to you today. And basically, I said I have some pretty concerning news. We just got canceled by our largest customer, as you know, and it was the ornament to our entire story. And I think it was either Philip or Tom. Both firms said the same thing. Like, why are you making this call? I'm like, because I don't want to be sitting in person and tell you this. So I want to know right now if this is going to cancel our meeting. So if this particular bit of news, which I will understand if it does, if you don't want to take the flight, Sarant, or if you don't want to, take the time, Fulcrum, they both said, no, we're still interested in what you're doing. Let's. So
you did the deal. How much of a hit did that take from the initial expectation of valuation?
I mean, those types of dollars are roughly getting 3x, so 2.1 million.
Okay, well, that's significant.
Yeah,
significant, no doubt about it. So we have to kind of get to a wrap up here. Yeah. And there was so much more to cover, and I didn't manage our time really right here. But I was just wondering, are you still in touch with or have any kind of relationship with the angel investor?
You mean XMI?
Yeah.
Not as much. I mean, we check in every now and then, but no, not really. I mean, well, right now we're still going through escrow stuff, so from that perspective, yes, but not really from a personal standpoint. One of our former board members, yes, I do. I keep in pretty heavy contact with him.
Good, and he was really your partner in the early stages and all that, I would think.
He was the most productive. Like he had the most experience from an operational standpoint. So,
I see. Okay, yeah. So he was most helpful for you. So what's the sort of high and low, if you will, of bringing in this institutional money when it came in, as you look back, because now it's been 2 years.
The high and low post or during the process?
Post. Because you went for 7 years with angels and now you're with institutions. Okay. And I know that Philip is a wonderful person and all that. Your other investors are too, but there's a difference now. You're a different company. You've got different partners.
I promise you, I would say whatever low it was, even though Philip was on. There hasn't been a low. I mean, in all honesty, there has not been a low point. I tell my girlfriends all the time that my life absolutely changed July 1st, 2019. And it doesn't mean that it's always easy, but my life changed for the better and Stratasan has changed for the better, period. Like it's,
Yeah.
and that doesn't mean it's been easy and running through fields of flowers and, you know, whatever, but I can say that there hasn't been a downside to it.
Well, it sounds like you've been on quite a learning curve here, you know, probably for
Yes.
the last 2 years as you're bringing in institutional money. They bring in those processes, as you say, and the disciplines that we don't have a lot of times as angels and entrepreneurs. So
If Philip were unmuted right now, he'd be saying, hell yeah, he has.
that's not even Philip. Phil wouldn't have done that. He's a pretty humble guy. I think he'd give you all the credit if I know Phil.
No, I mean, Fulcrum and I will say add Blue Heron out of Richmond and First Christ. They really have. They've been an unbelievable set of partners.
Well, thanks, Jason. I appreciate you taking the time to invest in our community. This has been super valuable, you know, and I do like the what you said is that I think that bad news does need to travel fast, and you have to trust that if you got the right people, they're going to stick with you and they're going to continue to do the deal, because then it's just a matter of getting the money right. They just saw you, they saw the opportunity, and it worked out. So congratulations.
Give me 15 seconds on that.
15 seconds.
I spoke to Tom Greer later, Tom and Philip and I told him, I'm like, I can't believe you all still invested when the LifePoint deal fell through. And Tom looked at me, he goes, you making that call on that Friday is one of the primary reasons we did invest, because we knew that when you told us a story, it was going to be true.
So we invest in integrity. That's super. There needs to be a proof point like that. So thanks for adding that. I appreciate it. So you see, you've got Jason's insight, my insight. You probably have insights from this conversation too. If you would send them to me, I'll include them in the recap that I'm going to send that on Friday, and I'd appreciate you doing that. You know, my weekly reminder to you always as an entrepreneur is watch your cash. It goes out fast and it comes in slow. So learn fast, decide fast, and go fast. Next week on the Zoom chat for entrepreneurs, it'll be on the September 23rd, next Wednesday, is my guest is going to be Rusty Gordon, who's a very good friend of mine and a serial entrepreneur. And the topic is, how much perseverance is too much perseverance? So it's going to be a really interesting discussion with Rusty being one of the elders in the entrepreneur community. So I think there's going to be a lot of wisdom shared, and should be very, very good on how long do you stick with something, really. So sign in early to catch up with people that you might know or new people that you might meet. I'll be there 15 minutes early. Remember, I am praying for you, and thank you all for attending. I'm going to end the call, the recording of this call right now. And after I stop recording, we'll keep the Zoom open. And for the next, up until 10 o'clock, we'll take questions that'll be moderated by my friend and partner, Greg Hinthorn. So thanks again for attending. Okay.
Thank you, Jason.